It's a countdown to chaos. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, the inevitable U.S. economic crisis, and why this time it's completely unstoppable. And you're not going to believe what the catalyst is for this next crisis, because it's not who you think it is. And it's coming far sooner than most policymakers want to believe. And I'm going to show you today why the U.S. economy is on the edge of a cliff. Plus, we're seeing an entire region of the global economy on the verge of an outright collapse. I'm going to show you why the policymakers got it completely wrong. And one sector of the U.S. economy was believed to be immune to any form of downturn, and now we're finding out it's going to be a huge driver of something the experts say can't happen. And if you're wondering what I'm doing in a toy store today, it's not because I'm getting a head start on my holiday shopping. You're not going to believe what I think is coming for this holiday season. And with that, let's head over to Bloomberg, where we kick today's story off with a headline: the ECB's high interest rates probably, keyword probably, stalled the Eurozone economy because nobody actually understands how the monetary system works. They think that if you just raise interest rates high enough, that for some reason it causes everything to grind to a halt. I'm going to show you why. It's not just high interest rates. It's something far more critical that's affecting not just the ECB. They're not just the Eurozone. This is something that we're seeing in the beginning of what is coming to the rest of the global economy. European Central Bank President Christine Lagarde warned this month that an unprecedented tightening in financial conditions is taking hold after 10 rate increases. And now we're starting to hear this story from all sorts of central bankers that, hey, you know, we went on the most aggressive hiking cycle. We've jacked rates up to the moon, and now they're finally able to kick in. It's just because they don't understand really what has been driving the global economy. They've been frustrated that their rate hikes haven't worked, and now they're about to, or at least we're going to show you what the catalyst is here. And when they do kick in full force, well, watch out. The central bankers are going to be cutting back to zero faster than they ever have in history. She said to have told the European chiefs earlier this week that the economy is likely to face stagnation in successive quarters, and that means high interest rates and high unemployment. And of course, we know when you put people on the unemployment line, they spend less, and guess what you don't get? You don't get high inflation in those environments at all. But here's really the catalyst for what's going on. Is that it wasn't just the fact that there's high interest rates, it's the fact that the long end of the treasury curve, we're going to use U.S. data here, but it's the same thing going on in Europe and Asia and all the major economies in the world, is the long bond did not buy into it. And here we have the yield curve shown in blue, and anytime it's under this horizontal black line, it means it's inverted, meaning short-term rates are higher than long-term rates. And what caused the short-term rates to go up? Well, it was the central bankers. And what do long-term rates function on? Well, growth and inflation expectations. So the Fed is saying, and other central bankers, that we think growth and inflation expectations are going to be a major problem. And the bond market saying, you guys are completely clueless. And sure enough, if we look at real gross domestic product, what we can find out is that any time you see an inversion in the yield curve, what follows is an economic slowdown or a recession, or even worse, a financial crisis. And this is something the central bankers just don't get. Because monetary tightening is being transmitted quite forcefully, and we've not seen the peak of it. Well, maybe that's the truth, because once the system grinds to a halt, and we make the case, this is all about money, and once the global financial system runs dry of money, you're going to watch it kick in, and you're going to watch also at the same time, the central bankers are going to say, well, it wasn't us. We didn't have anything to do with it. We were just tightening things up a little bit, and we didn't know the whole system was going to break, because they don't know how the system works. And we think that core inflation and headline inflation will get back to 2% sooner than the ECB forecast. Same with the Fed, and that's because we have much weaker economic activity forecasts. And that is one of the key points here that I want to show you, is because the economy is a function of demand, and inflation also a function of demand. Here we can look at this chart here. The net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. This against U.S. real real GDP, and it's just a function of when the system dries up of money. And that's what happens when banks constrict the issuance of new credit and new loans into the economy. Same thing going on in Europe, same thing going on in Asia. Lo and behold, what happens? They tighten standards and growth slows. And here we see it again in the global financial crisis. We tighten, it contracts. And now we're seeing banks tighten, and all of a sudden growth is kind of resurging here. And we've made the case before that this wasn't just a normal growth cycle. It had everything to do with credit and pandemic savings. But the central bankers are saying, no, this is just a repeat of the 70s and the resurgence of inflation. And sure enough, we'll see that it's all going to come crashing down, because when you take a look at real gross domestic product, and we'll just stick with the U.S. data here and overlay the consumer price index, that's shown in blue on a year-on-year rate of change, and you'll notice there isn't one that leads the other, but essentially they're the same thing. And what you see is consumer price index, a function of demand, leads real GDP down. And then you see going into the 90s recession, real GDP fell and then inflation fell. They're both a function of demand, and this is what central bankers don't get. They think it's just a matter of raising interest rates. They don't understand it's the inversion of the bond market that matters here, and the constriction of the creation of new money. There's better ways to do this if you want to slow down the economy. The problem is they're not just slowing it down. They inevitably have slammed on the brakes, full force, both feet. They don't even know it. And the problem is we're coming right at the edge of a cliff, and there's nothing that's going to stop it, because the U.S. economy, as you're about to see, is far closer to a recession than any of these experts want to suggest. And mortgage rates at 8% make a brutal U.S. housing market even worse. Now remember, this sector, the housing market, we were told, and it was immune to any form of downturn. We said not likely to happen. It's going to be the opposite. The housing market's going to go. And as we've seen in China, the housing market is critical to an economy. In any major economy, it is critical. Absolutely same thing in the U.S. Everyone said, no way this thing's going to slow down. There's way too much demand. And I said, you'll see when the U.S. housing market goes, and it inevitably will, it's going to lead to one major problem that not even the central bankers think is going to come. These days, few buyers that are still hunting are fighting over scraps, and the move higher in rates is making it worse. Applications for purchase loans have fallen to the lowest level since 1995, and contracts to buy homes were canceled in September at the highest rate in almost a year. Even builders who have benefited from tight supply of resale homes are becoming more concerned about the outlook. And you may recall that builders were super optimistic, and they've been breaking ground and getting permits like wild because they think there's going to be a huge boom in housing. Well, one of the problems is when we see a slowdown here, it's going to lead to one big problem, and that is a lot of unemployment, because the housing market and all of the kind of outlying industries that support it, not just directly, but you think indirectly, as we're going to show you here in a little bit, when they slow down, it is going to lead to more people losing their jobs, spending less, and driving not just the U.S. economy, but the global economy off a cliff. But builders are expressing more caution, which is strange. Nearly 1/3 of companies say demand is slower than expected. There's some words that we're going to continue to see in the months to come, and causing concern. This according to an October survey by real estate consulting firm Zonda. That's up from 14% in August and 16% in September. So clearly more signs, not just a slowdown in certain sectors, but if we made the case, when you slow down the creation of money, it eventually affects everyone, even the home builders. And a slump in big purchases clashes with government's strong consumer data. And one thing that shouldn't be slumping right now is your trading account. And many people say, Steve, can your reports be that easy to use? Do they work that well? I'm going to show you. Here's a new one. Here's one we haven't looked at that just triggered on Friday. Here's one. And remember, we told you there's 5 free coupons for both reports that gives you a month free. They got exhausted. Some of you said, hey, can you give me some more? I missed it. I want it again. So here you go. Here's your chance. You missed out. There's 5 new ones I put up here for Saturday. For each report, you get the coupon, you get a free month on me. Check it out, CTA Timer Pro on Friday, October 27th. We tell our subscribers these are the signals to watch for when you get down to this minus 100% across the board and you see the machine short covering. Now, this is our mimic of the machine positioning, and you can find out more about that on our Sunday show. But this is the first signal. Then the second signal, you go to our Momentum Timer Pro report. This on special right now, $20 a month. Lock it in for life. Here you see IEF, same thing, one buy signal. This is our technical report. This looks at all those technical indicators that many of you look at, smooths them all out. And when we get confirming signals on both of them, that's where you want to put a buy at market open. Had you did that on Friday, you want to put your stop loss probably around 50 cents lower, maybe a little more, whatever you're comfortable with. You'd already be up 0.23%. And I think, wait a minute, that's not much. It's just the beginning. I want to show you how these signals work. Many of you said, can you help me out with that? Can you show me? Well, here you're seeing it live on Friday. Both those signals tripped. It's already up. We'll see it where it heads in the weeks to come. We'll come back and follow up with that, hopefully sometime next week. But meanwhile, shoppers think long and hard before buying a motorized vehicle or washing machine. And this again, you talk about coming back to the housing market. People buy homes, and then what do they buy? They usually buy a car. They buy washers and dryers. They buy window coverings. They buy all kinds of things. Pools, spas, big ticket items is what they spend their money on. And we're seeing that slow down in a big way because they're increasingly reconsidering all of them. And that's a bad sign for the U.S. economy that's been kept afloat and out of recession by the willingness of Americans to keep spending despite high inflation and interest rates. And we've been making this case on the show that demand is coming down. It's not just in one sector or two sectors. It's going to be broad-based because when you constrict the creation of new money, nobody is safe in this environment. And sure enough, we're starting to see some concerns here with how the real estate market, and wait till I show you what else is coming. The softening demand, which includes customers trading down to cheaper models, has sparked discounting. Wait a second, we've been told that inflation is a problem, and when you hear the word discounting, that means lower prices, disinflation, potentially deflation if they go down low enough, but we're seeing it here in the data right now as promotions are back to pre-pandemic levels after waning the past 3 years because COVID-19 upended supply chains and limited production on top of flooding the economy with a pile of money. Being back to a pre-COVID promotional environment is not surprising. However, we expected this to occur in 1 to 2 quarters later. So here you see again, demand slowing down faster than anybody has expected. Of course, we knew this was going to happen. It was just a matter of time before that COVID money dried up, and now we're seeing it's gone. And one explanation for the divergence is that Americans are soured on the future. Polls show waning confidence in the economy. There's also a threat of a government shutdown and a wider war in the Middle East. And I'll just tell you this, at no point does any shopper go to the store and say, hey, you know what, I'm not going to buy this because there's something going on in the Middle East, or maybe because the government's going to shut down. Most people don't even think about that. They're too focused on their own budgets, their own finances, and the problem is they're seeing, even at their own employer, they're seeing work slow down. They're getting nervous because they know the next thing that comes are the layoffs. And sure enough, many Americans say their household expenses are outpacing earnings this year, according to an AP NORAC poll. And this makes perfect sense. You want to know why inflation is coming down? You want to know why demand is coming down? It's because of the same case. It's not just the fact that banks are tightening lending standards. It's the fact that wages aren't keeping up with inflation, and that means less money gets spent. We've been making this case, and now we're seeing that consumers are finally agreeing. About 2 in 3 Americans say their household expenses have risen over the last year, but only about 1 in 4 say their income has increased in the same period. And the household expenses outpace earnings. Many are expressing concern about their financial futures. No surprise, because what have consumers been doing? Taking on too much debt. They bought into what the policymakers told them. They did. They said, hey, there's going to be a soft landing. Things are going to be great. Wages are going to keep rising. We said, no, not going to happen. And now consumers are saying, whoopsie, we're starting to get concerned. And you know what it means when consumers get concerned? They stopped spending. And what's more, for most Americans, household debt has either risen in the last year or not gone away, as consumers have chosen consumption over spending, paying down their debt. And what do we know? Going into every recession or financial crisis, debt levels are usually at record high and consumers get tapped out. Of course, the wise have paid down their debt. I know some of you have. You say in the comments, good for you, but guess what? Most people aren't. And here is the evidence. The consumer price index shown here in blue against total compensation. This is the average hourly earnings multiplied by the average weekly hours for production and non-supervisory employees, shown on a year-on-year rate of change. And we've made the case that every time you see a collapse of inflation, every single time, it's because total compensation growth is less than inflation. You see it here in the current cycle. We know that demand is coming down. You see it going in the global financial crisis. How about the dot-com bubble? It was the same event. Even the slowdown here, we didn't see it quite during the slowdown into 2015, 2016, but we can go back to all prior recessions. You see CPI come down, you see GDP come down, you see everything coming down. And once consumers lose confidence about their financial future, it's key. They do one thing and they do it every single time, and that's cut spending. About 8 in 10 Americans say their overall household debt is higher or about the same as it was a year ago, which isn't a good thing. And about half say they currently have credit card debt. 4 in 10 are dealing with auto loans, and about 1 in 4 have medical debt. Just 15% say their household savings have increased over the last year, and those 15% that have are going to be in a great position to take opportunities as they come forth in the equity markets and investment markets, whatever they like to invest in. Those opportunities are going to be there for them because cash is king at the bottom of a recession. And sure enough, we also made the case. This is from the University of Michigan. This coming from the report on Friday. Consumer sentiment, and this is preliminary data, confirmed its early month reading, falling back to about 6% this October, following 2 consecutive months of little changes. And here we can see that confidence, not only sentiment, current conditions, expectations, all coming down. And I warned you, and I said, when this happens, when consumers lose confidence, they stop spending. When they stop spending, employers eventually lay off. It's a bad cycle that starts to occur, and then we saw this rise. And of course, we know that also consumer confidence linked to the equity market. So if consumer confidence falls, guess where stock prices are headed? And now we get to the notion, why is Steve at a toy store today? Because he's not doing his holiday shopping just yet. It's because I think there's going to be a whole lot of big discounts later this year. As Hasbro, Mattel, Dark, and already muted holiday shopping outlook, and you start to get a picture here why the U.S. economy is headed off a cliff, as Mattel, which makes Barbie dolls and Hot Wheels, and Hasbro, the maker of Nerf guns and Transformers, signaled this week that the key shopping period isn't looking great, with both effectively lowering expectations for the quarter. So here we can see early sales data telling you there's a problem coming. We warned you. It was a matter of time. And so now you see all this early data suggesting slowdown in U.S. consumption. That means global economy off a cliff. And for the retail industry, there are more headwinds than tailwinds at this point, even as inflation is moderated and the job market remains relatively and historically strong. I would describe the consumer as stretched. And sure enough, they're stretched. Record debt. Wages coming down. We know this. And here you can see average advanced retail sales, this shown in blue, against total compensation of production and non-supervisory employees in red. And sure enough, we note that this recent rise in retail sales, there were 2 factors. One of them was a big increase in revolving debt. That was one. But notice the trend here. When you see total compensation grow slow, retail sales eventually comes down with it. And we're starting to see that preliminary data giving us all the signs we need, because now we know the U.S. consumer is walking toward a cliff. This from a strategist here who thinks the U.S. consumer is headed off the edge. He said the slew of recent economic indicators has showed consumers are quickly running out of excess cash while household savings are coming under pressure. Both cases we made on this show, the savings is coming down, cash is going away, and that means the U.S. consumer tapped out, the economy off a cliff. Of course, retail sales have been quite strong for the past few months, and everyone gets quite excited about that. But if you actually look at what's going on, the household savings ratio has been run down, and in fact, real income growth has been negative for 3 months. So it's not quite all good news. I mean, quite the reverse, he said. I think there are some real challenges coming from the U.S. consumer, and sure enough, not only is their wage growth, total compensation slowing, look at this, advanced retail sales against the personal savings rate almost mirrors of each other. Here we can see this recent rise in retail sales, everything to do with drawing the savings rate down. At some point, the U.S. consumer says, hey, you know what? I need to rebuild my savings. There goes retail sales. At the same time, their compensation growth is slowing. Demand goes down. Consumer price growth slows. That means fewer wage increases, and then the layoffs start to kick in. We see at the margin the consumer is under a lot of pressure, and in fact, the labor market is under a lot of pressure as well. A case we've been making is coming. We had good payrolls, but if you look at a lot of the indicators of where the labor market is likely to go, a lot of them are fraying on the edges. We're going to get to the point in the next few months when I think the labor market starts to deteriorate more meaningfully, and that'll kickstart a recession when we get there. That's exactly what we've been saying, is that once the initial claims data starts to rise, it's game over for the U.S. economy right off the edge of a cliff. And what does it mean for the equity markets? Well, he says I can see a bounce for a month or two, but not if consumer confidence continues to fall. As I say, it's been quite beaten up. Markets have been coming down since July, but I think net, if you want to be underweight equities, if you're looking beyond next few months, he said, I think the U.S. is in for a tough time. Well, if we head off the cliff into recession, guess what's going with it? That's the U.S. equity market. So as we started the show, who's going to be the surprise catalyst for the next recession? Well, it's going to be the U.S. consumer. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.